Hello students, welcome to Actuarial Science videos from iPoint. I am Gopal Goel with 20 years experience of teaching this wonderful subject called Actuarial Science. There are very few papers in Actuarial Science that I have not taught. This particular video is primarily for SP8 students, but students of other subjects like SP1, SP2, SP7 and to some extent CP1 students can also benefit immensely from this video. This video has a very limited scope and focus. It only talks about financial reinsurance or finite risk reinsurance and a runoff reinsurance. These are the only two topics covered in this video. So when you look at the overall scheme of things, this is the fourth video on reinsurance for SP8. Useful in other papers also. Okay. So let us dive straight away on financial reinsurance or finite risk reinsurance. To have a good overall understanding of the financial reinsurance, also called finite risk reinsurance, these are the points to ponder. These are the points that you can quickly go through. That how is it possible that we have a reinsurance arrangement which has little or no element of risk transfer? Without transferring risk, the insurer gets an arrangement which looks like reinsurance. Okay. Number two, what is the fundamental difference between risk transfer and risk financing? Number three, how is it possible that just smoothing the earnings or the profits of an insurer can help reduce the cost of capital for the insurer or boost the solvency position of the insurer? Then, what is the idea of pooling across time? As actuarial science students, you are all aware of pooling across a wide group of policyholders, across a large group of independent risks. But can the idea of pooling be extended to time? Can we create a pool over a number of years? What is that idea and how it is relevant for financial reinsurance arrangements? And finally, we will look at exactly 4 financial reinsurance solutions in this video and how they can be considered as an extension of more fundamental concepts like cash flow matching, claims equalization reserve, financial accommodation and future adoption. Actually, the solutions have been inspired from these concepts only. So, I would like to begin with what is reinsurance in the first place. If we want to contrast a real reinsurance with financial reinsurance, which only on the surface looks like reinsurance, but it actually a financing arrangement. So, it is important we know that what are our parameters? What are our criteria on which we say, oh, this is a genuine reinsurance arrangement? Or no, this is not a genuine reinsurance arrangement, though it looks like a reinsurance arrangement, though it serves some of the purposes of the reinsurance arrangement, but it's basically a financial product. So let us start by first discussing what is reinsurance. So it is obvious that in a genuine reinsurance, there is risk sharing. Partial transfer of risk from insurer to reinsurer is practically risk sharing. For convenience, you may call it risk transfer without emphasizing on the word partial. But no doubt, in reinsurance, there is always a partial transfer of risk from insurer to reinsurance. So the more appropriate word is risk sharing. This risk sharing may be on a proportional basis involving all the claims, or maybe on a threshold basis where the sharing is only for large size claims, claims larger than that threshold, not in all the claims. Second, this risk sharing is the first element of a genuine reinsurance arrangement. Second element. Similar to risk sharing, there is also sharing of premiums on a reasonable basis. Whatever premium the direct writer has received from the client, a part of it is paid to the reinsurer, because now the reinsurer will also be sharing some of the risks. Usually, this is a one-year arrangement where there is no obligation to continue or renew it at the end of 1 year. It is renegotiated at the end of 1 year to reflect the changes in the underlying business volume, nature of business, classes of business, or changes in regulation or court award, or other changes in the external world. So it is basically renegotiated at the year end. So being a small term contract, being a 1 year contract, there is no allowance made for the potential investment income for the insurer or the reinsurer while we will calculate premium and reinsurance recoveries. The fifth point, the most important point, except for some profit commission that we have discussed in the first or in the second video on reinsurance, except for some profit commission, in a genuine reinsurance arrangement, there is no provision for sharing of reinsurer's profit with the insurer. Profit is seen as a reward for risk taking. So to the extent insurer was taking the risk, sharing the risk, it is entitled to profit to that extent. And to the extent reinsurer was sharing the risk, it is entitled to profit up to that extent. So there is no case that if the experience has been exceptionally good and reinsurer has to pay almost nothing, so there are almost zero reinsurance recoveries. So reinsurer is not bound to share the initial premium with you. We will see shortly that in financial reinsurance, this is often the case that the results at the end of the contract period will be shared with the insurer. Profit or loss will be shared with the insurer. And that is why there is little element of risk transfer between a insurer and the provider of financial reinsurance. Now the question arises that why would an insurer like to go for reinsurance? Or what are the benefits of entering into a reinsurance contract? Do we get same or similar benefits of from financial reinsurance, or do we get slightly different benefits by entering into a financial reinsurance arrangement, right? So through such an arrangement where some risk is transferred, some premiums are transferred, and both have rights to enjoy their profits, 1 year contract, no obligation to renew after 1 year, but with negotiation to make changes according to the other fundamental changes, contract can be extended, right? What is it that the insurer gains? Number one, risk reduction through risk sharing, freeing up of some scarce capital, leading to improved solvency or writing of more business, increasing the size and volume, or leading to lower costs of operations through greater diversification, through greater market share, through greater potential for profit, through greater scope for client retention and relationship building, through lowering of distribution costs, or to overall business growth. So benefits are many. However, what reinsurance does not provide, that is also important to note. what reinsurance does not provide, and what is not the aim of reinsurance. The aim of reinsurance is, it is not one of the aims of the reinsurance to provide finance to the insurer. That is not the aim. The aim, the focus, the intent is risk sharing, not providing of finance. And reinsurance arrangement would invariably lead to reduced profitability on the ceded business. Having outlined the characteristics and benefits of genuine reinsurance, now I would like to draw parallel with financial reinsurance. Financial reinsurance or finite risk reinsurance fundamentally differs from traditional reinsurance in its aim and intent. The aim of a financial reinsurance arrangement is to provide finance to the insurer. We will discuss 4 different financial reinsurance arrangements. Right. But for any of these 4 arrangements to succeed, there is a certain condition. And that condition is very simple, which is often very easily met in practice. And that the condition is that the general insurer's business must be profitable on average. Which simply means that the premium charged, the rate of premium charged must be greater than the average claim size. In practice, this is most often met. So if the business is profitable on average, then it is very easy to design a financial reinsurance arrangement to help the insurer with finance and reducing the cost of capital. Okay. So having made these initial points, now I list down the aims and intents of financial reinsurance. Number 1 aim is risk financing, typically over a multi-year period. Unlike traditional reinsurance contracts, financial reinsurance contracts are not 1 year period. They are multi-year period. 10-year, 20-year, 25-year period contracts are not out of place. They are multi-year period. So their aim is either to reduce the capital requirement. So this is an indirect way of providing finance, or reduce the cost of capital to the direct writer. That is the aim in it. And while do so, they take explicit allowance of the investment income, which is generally ignored under the 1 year traditional reinsurance arrangement. So some investment time risks remain in financial reinsurance, like counterparty risk and market risk. So we will come to details a little later. Now, instead of risk transfer, there is just risk financing. So the first fundamental difference is that the insurer, the direct writer, is not obliged to share its premium with the provider of the financial reinsurance. There is no need to share premiums with the provider. So how does it work? What is the incentive of the provider? We will explore in detail. The only difference is that if funds were invested in some investment directly by the insurer, whatever return the insurer could have earned directly on its own, a somewhat lower, that I will explain how, a somewhat lower return is credited to the account by the financial reinsurance provider, and the difference between the return that could be earned and the return that is actually credited to the insurer's account, the difference is the incentive for the financial reinsurance provider. So I know fully well that the idea is only introduced. It is not yet, I am not yet done with explaining the idea. So, but just keep in mind somewhat lower return. And just keep in mind that there is no need for the insurer to share its premium income with the provider of the financial reinsurance arrangement. Just keep in mind these two things. Right? Now, before we proceed further, there is a word of caution. Since there is no element of risk transfer here, the direct writer or the insurer who is seeking out this arrangement ideally should not be called cedent. Should not be called cedent. Because no risk is being ceded. Ideally, the insurer should not be called cedent. However, most textbooks, most material available on the subject would invariably use this term for the direct writer, and there are two good reasons for doing this. First, this has gained acceptance through uses. In industry, this is commonly used, so this has gained acceptance. It is only while writing the exam answers you should be careful that no risk is being ceded. No premiums are being ceded. So it is just a use system. Now there is one more reason. Very strong reason. During introduction I mentioned that these are new developments, right? They came around in the decades of 1980s. So a little over 40-year experience is that. So it takes time to get popular, to be widely accepted. Then came the regulatory backlash. Initially, a regulatory response was mixed. Some regulators were okay with these arrangements, some were not okay with these arrangements. But over time, a consensus evolved that if such arrangements are to be considered for solvency purposes, if such arrangements are to be considered while demonstrating solvency of the insurer, they need to have at least some element of risk share, some element of risk transfer. Otherwise, they would not be qualified to be considered for solvency demonstration purposes, and some of the intended benefits would not be there. We will highlight this amply with the time and distance deals in a short while. The moment regulation changed, time and distance deals lost their popularity. So, if there is some element of risk transfer, then it is okay to call the insurer cedent. So, because of these two reasons, use of this term is very commonplace. So, don't bother too much about it. But if there is a specific question, be careful to write that there is little element of risk transfer here. So, technically, we should not call it cedent. It is just because of usage that we call the direct writer cedent. Now, let us play a game. A very simple game. This very simple game will highlight the difference between pre-funded financial reinsurance arrangements and post-funded financial reinsurance arrangements. Some arrangements are called pre-funded, some arrangements are called post-funded, right? Let us play a game with me. Consider yourself as a direct insurer and consider myself as provider of financial reinsurance. Right? I offer you a very simple deal. You will get to throw a dice, normal dice, 12 times, and the number on the dice is your claim liability towards your client, because you are a general insurer in this game. And I am your financial reinsurance arrangement provider. Okay. Now, all of us know that the average value of a die is 3.5. So, the average value of the claim that you have to pay to your client is 3.5 here. Okay. And you are going to play the dice 12 times. So, 12 multiplied by 3.5 is 42. Okay. So, you deposit 42 rupees with me. Now, there is no risk. No matter whether the claim is of 1 rupee or 5 rupees or 6 rupees, I am there to pay you back. So, you pay me 42 upfront, I will deposit it in your name. It will earn some interest also. So, let us say it earns interest at the rate 8%, but I will credit only 6% to your account. Remaining 2% is my incentive to be part of this deal. Okay. So now it is a 12-year deal. Year to year your claim outgo will vary, no matter whether it is a small 1 or whether it is large 6 or some intermediate value 3, 4. I am there to pay you, don't worry. So you have funded me in advance. It is a pre-funded arrangement. So I hope maintain an account in your name. Whatever be the balance that earns an interest of 6% for you. Actually the investment earns 8% interest, so you are getting a somewhat lower return. After the end of 12-year period, either there will be a positive balance in this account or a negative balance in this account. Negative balance if there are more 6s than 2, because out of 12 outcomes there should be 2 6s if all numbers are equally likely, then 1 twice, 2 twice, of course. So it may be a negative balance or positive balance that we will settle at the end of the 12-year period. Now the question is, are you an insurer large enough to pay 42 upfront? Usually that is not the case. That is not the case. So usually you would be paying me on an annual or quarterly basis. And correspondingly the investment income credited to the account will be lower. And mind you, if the account balance goes into negative, then I will charge you 8%. Then I will not charge you 6%. If the account balance is in the positive, then I will pay you 6%. Then I will not give you 8%. So, but the point is, you are free from claim amount volatility. You don't have to bother about the claim amount volatility. Very simple arrangement. Okay, we will extend the idea. Now, I will make 2 notes before I move. Longer the time period of such a deal, greater the probability that the account balance at the end of the period is 0. This is what we call a statistical regularity. Smaller the time period of the deal, greater the probability that there is some negative or positive balance in the account at the end of the time period. As sample size increases, you know the distribution tends to be normal. So sample mean X bar tends to be mu 3.5. So that is one of the reasons, that is my way of explaining that why financial reinsurance arrangements are practically multi-year contracts, not 1 or 2 year contracts, right? Now since this works for multi-year period, the investment income is going to be significant. It is not going to be small pennies. So interest income can contribute a lot. So it is quite possible that I can work out the present value in advance or expected present value in advance, and instead of asking 40 from you, let the account may start with 40 or 39 or even lower. Second note, practically no insurer will have this much amount upfront. Basically, you are paying for 20 years or 30 years average claims in advance. That much capital hardly any insurer has at their disposal. So the payments from your side would be periodic. You are paying at the start of the year or start of the quarter. I am paying you at the end of the quarter. Hence it is pre-funded arrangement. Correspondingly, we can have a post-funded arrangement. You play first. You throw the die first. Right? You figure out the amount of claim that you need to pay to your client. you get the money from me, you pay your client, and then you pay me later on, as per the arrangement, whatever be that arrangement. So that is post-funded. Play first, play out the compensation needed, right? Pay the balance later, right? So you get to throw the die first 12 times, and so on. So your only obligation will be, you will have only one obligation under this contract. That is, you set the account balance 0 at the end of the contract term. At the end of the contract term, you set the balance to be 0. Again, interest is credited or charged, depending upon whether the balance is positive or negative, whether you have paid me more than what you have taken out or less. Again, if the balance is positive, I will give you somewhat lower return, but if the balance is negative, I will charge you full interest or somewhat higher interest. These are very simple, very crude examples, right? Now move towards a more realistic example. Since the average claim size is 3.5, right? You always assume that the actual claim size is 3.5. So if you are paying only 1 to the client, you pay the balance 2.5 to me. If you are actually paying 2 to the client, you pay the balance 1.5 to me. And in the event you have to pay 4 to the client, you take 0.5 from me. In the event you have to pay 6 to your clients, take the balance 2.5 from me. So in some years you will receive money from me, in some other years I will receive money from you. But there will be no claim volatility for you. Your actual outgo will be capped, will be fixed at 3.5 every year. And your only obligation is that at the end of the contract period, you may ensure that the balance is 0. Right? So if it is a multi-year period, the chances are very high that the balance is very small or 0 on its own. Right? If it is interest earning is significant, then also there are very high chances that the balance is 0 because your business is profitable on average. Now we start discussing some specific financial reinsurance products or FinRe products. The first FinRe product is time and distance deals. Second is spread loss covers. Third is financial quota share. And fourth is industry loss warranties. In these, time and distance deals are inspired by cash flow matching. The fundamental idea is same. Spread loss covers are inspired by claim equalization reserve concept. The fundamental idea is same. Financial quota share is inspired by financial accommodation. And industry loss warranties are inspired by the theory of options. So, what are the specifics about time and distance deal? Before that, let us discuss broad features. Right? Time and distance deals are designed to match claims outflows in size as well as timings. So, they practically sought to exploit a regulatory anomaly. The moment the regulators removed that anomaly, the utility and the attractiveness of time and distance deals ended, so now they are not that popular. And they are inspired by the cash flow matching concept. Spread loss covers. They are actually aimed at earning smoothing. Earning smoothing or profit smoothing of the insurer. And to some extent, you can compare it to aggregate Excel or Cat Excel. These type of financial reinsurance products are most useful, very useful, if you have insured risks with very, very low probability Very, very low frequency, extremely low frequency, but extremely high severity. We have a term for such events. Such events are called black swan events or miraculous events. Extremely low probability of occurrence, but extremely high intensity of, extremely high severity of claim. Extremely high severity. So if your business is of this nature, spread loss covers can be very helpful to you. And they are obviously inspired by the concept of claims equalization reserve. Only that is, the claim equalization reserve is held internally by the insurer itself and invested in some very safe assets. Spread loss cover involve an external party. That is the only difference. Fundamentally, they operate like the same. Third is financial quota share. This is a very innovative way of providing finance to the direct right, which is disguised as a quota share, a traditional quota share. We will come to details in a short while. So, its utility lies in the regulatory restrictions to access capital markets for obtaining finance. In India, there are onerous restrictions on insurers. Tier 1 capital is the share capital. Bond capital is called Tier 2 capital. When you borrow from banks, etc., that is called Tier 2 capital. In India, if an insurer wants to raise Tier 2 capital, there are many restrictions, many explanations, justifications you have to provide to the regulator, convince the regulator why exactly you need this money. What for? Because being an insurer, right, you are a cash cow, you are a cash money machine. What you sell, you only sell promises. Only sell promises. And what you get? Cash. So why you need to get more cash by selling bonds? Why you need to get more cash by borrowing from a bank? You have to explain. So you can beat all those restrictions through an arrangement called financial quota share. How exactly it operates, we will come to details in a short while. And the idea is inspired by financial accommodation, which has been practiced very long between businesses. And if you are a student of commerce, if you have been a student of commerce, and if you had studied bills of accounts at your 12th accounts, then you know there is an idea called bills of accommodation. So the financial quota share is inspired by that basic idea of financial accommodation. Finally, industry loss warranties. They are designed to provide a prefixed payoff, much like payoff of a binary option. So its utility lies in that it is suitable for managing catastrophic claims. If you have exposure to catastrophic claims, then you can consider, for no other line of business it is suitable. It is designed in such a way, right? Catastrophic claims, most useful. And they are inspired by the idea of binary option that you have come across in CM2. You might be recalling binary option, you might not be recalling it. Binary option is nowhere there in the study material of CM2, but it is examined by examiners. So it is found in question papers. Now what is time and distance deal? Before that, let us focus on a regulatory anomaly. In CM2 or in CT6, depending upon when you gave your exams, you have come across an idea called run-off triangles. And if you are working in the general insurance industry, you might have used run-off triangles for IBNR reserves. Incurred but not reported. Incurred but not enough reported. IBNR and IBNER. So, what is the anomaly here? General insurance contracts are 1-year contracts. So being short-term contract, you must not take advance credit of any investment income which is not going to be significant by any means. Fine enough. But the premium that I took for 1 year, so my exposure is for 1 year. Any accident that takes place in that 1 year, any event that occurs in that 1 year, may not get reported to me in that year itself. May not get reported to me in that year itself. Reporting delays can make this short-term business into a long-tailed business where claims will get reported over a very long period. It may stretch to 8-10 years. Now tell me, should I not take any advance credit of my investment income? Projecting my claim patterns, I will set up reserves, then I will invest those reserves somewhere. So definitely there will be some investment income. So there was a time, there used to be a time when we say, oh, no, don't take present value. And I doubt, if you're in CT6, if you recall your CT6 or CM2, did you allow for time value of money in run-off triangles? I currently teach CM2, I know that we do not make any allowance of time value of money. So gross reserves are held. So even if we run the triangle up to 10 years or 12 years, we do not take any time value of money. We do not apply discounting. So this is the regulatory anomaly that I was talking about. Not allowing credit for investment income on reserves held, technical reserves held. Okay, fine enough. Now tell me, you are direct insurer, I am the financial reinsurance provider, right? Tell me, I look at your triangle, I look at your projected values in the triangle, I figured, okay, you need this much money after 1 year, you need this much money after 2 years, you need this much money after 3 years. You say yes. Okay. I say I offer you an annuity. I offer you an annuity where I will provide you exactly this number after first year, exactly this rupee, this much after 2 years, 3 years, 4 years, so on. Now your outgoes are perfectly matched with the inflows that you get from me. No risk. Only one risk. Actual figures are slightly different than the projected figures. So that you can easily manage. Now tell me, what will you pay for me this annuity? Undiscounted value or discounted value? Neither you are a regulator nor I am a regulator. We are not regulators. So in this B2B deal, in business to business deal, you will surely consider this cash flow stream. You will discount it. Of course, at what rate we discount, on that we can agree. That it may not be the market rate, it may be somewhat lower. So you pay me that much money. Anyway, you have to create reserve. Anyway, you have to invest that reserve somewhere, someplace here, in a safe asset. Why don't you invest it with me? I'm a large investment bank or I'm a large reinsurer. Invest that money in my annuity. So undiscounted value is say 200 crore. Discounted value is say 172 crore. Depending upon how long the triangle is. The discounted value may be just 190 crore if the triangle is short. So whatever it is, you are going to save that money. Now the question is, will the regulator accept this? Will the regulator say, okay, since you are perfectly matched, since your claim outgoes are perfectly matched, we have no issue. You have done a wonderful arrangement. We are pretty satisfied. Okay. So that will free up your capital, or that will boost your solvency, or you can use that money to write more business to boost your profitability. The choice is yours. So that you can discuss at your business strategy meeting with the board. Will the regulator accept it? The regulator can point out one thing. There is a credit risk. What if I default? What if I don't pay? What will you do in that case? There is a counterparty risk. You can't consider this asset as completely risk-free. With this strong objection, regulator may not allow this. What about default? Tell me. Okay. So the initial response was mixed. Some regulators allowed it, some regulators did not allow it. But very soon, the regulators saw their folly, and now it is possible that you are in a territory where after run of triangle, whatever your projected figure, you are allowed to hold the present value of that figure only. Of course, the present value may be found at a prudent rate. So again, somewhat lower rate. You may use a prudent interest rate, a smaller interest rate than the current prevailing market interest rate to discount those cash flows. Quite possible, right? So, if you look at Lloyd syndicates were not allowed this discounting. So Lloyd's changed its rules. So now Lloyd syndicates can also take benefit of this discounting. And once that started happening, time and distance deals lost their attractiveness. Now they are no longer as popular as they once were. But it is quite possible that in some territories you find some insurer who still have some time and distance deals on their book because they were long-term arrangements. So consider someone who entered into a time and distance deal in the year 1993 or 1994 before the regulator changed the rules, and they entered a 30-year deal. So that would have just expired. But what about a territory where the rules were changed only in 1999? And in 1997, the insurer entered into a 30-year time and distance deal. So this deal will still be there in their books of accounts. So that is why it is still part of the syllabus. We can't exclude it from the syllabus. We don't know in which territory you would be working, which client you will be assisting. And why 30-year deals? Why 30 years? Oh, there may be a 40-year deal also. Of course, I am not aware. I am personally not aware of any 40-year deal. But I am just raising a technical possibility. Now we move to spread loss covers. Something like the dice that we were playing. The basic idea is to provide earning smoothings. Despite volatile claim experience, the reported profit figure in the profit and loss statement and the balance sheet would not fluctuate from year to year. Let the claims fluctuate, but let earnings not fluctuate with the claim experience. So, not very high earning is reported with very low claim experience, and not very poor earning is reported after an extremely adverse claim experience. How is it possible? Quite possible. So, if your claims experience has been fluctuating widely from year to year, so your reported earning figures would also be fluctuating over year to year. As financial reinsurance provider, I have a solution. Right? So the contract is very similar to an insurance contract between a policyholder and a direct writer. Similarly, this is a contract between an insurer and a reinsurer. If the outcome is good, enjoy that outcome. If the outcome is bad, you call upon me, I will compensate you. Okay. So let us say how it works. The ceding insurer, the direct insurer or the cedent pays an annual or maybe a single premium to the financial reinsurance provider. Right? That premium amount is credited to an account called experience account. And interest will be provided on that interest account. Like the game I played with you, pay me 42, then मेरे से लेते रहना, claim देते रहना. Okay. So whatever be the balance that will accumulate at somewhat lower interest rate, because I have to make money out of this deal also, right? It should be commercially beneficial for me also, no? I have my expenses, right? So the balance accumulates. If you have financial muscle big enough, you pay me single premium. If you don't have that type of muscle, pay me annual premiums. Collect your premium first, then pay me. The arrangement can be made quarterly also, depending. It is on your convenience and my convenience, right? Okay. So now what? Now what? You will never ever have an adverse earning experience. When the claims are excessive, you can draw from this experience account. When the claims are not excessive, you can put additional money into this experience account. That is very easy. And by the end of the contract period, we will settle. So this last part, sharing of results with the ceding insurer, sharing of results in this fund, that makes it a reinsurance arrangement that works like a reinsurance arrangement, that appears like a reinsurance arrangement, but does not involve any risk transfer. Since you have to clear the balance at the end of the contract period, the ultimate risk remains with you. The only thing is, it has been smoothed out over a long number of years. And this is exactly what we call pooling across time. This is exactly what we call pooling across time. And this also makes it clear how earning smoothing can help cover the cost of capital or boost solvency. You don't need to hold solvency capital, free assets on top of it, capital, technical reserves. Because you have a resource called experience account. You can draw from that. So in good years, you are putting money into that good experience account. In bad years, you are taking out of it. If you remove the condition that clear the balance at the end of the contract term, then there is genuine risk transfer. Then I as a reinsurer would bear that balance, whether positive or negative. Positive will be my reward for sharing your risk. Negative will be my bet misfiring on me. Because this is a risky proposition. So since the balance can be negative, that is a risk. Balance can be positive, that is a reward for taking that risk. Then it will be a genuine reinsurance arrangement. But in financial reinsurance, We have this element of sharing the results with the direct insurer. Now, the third one. Before I discuss financial quota share with you, I would like to highlight one more point. The second question on the board. What is the fundamental difference between risk sharing and risk financing? I hope after all these examples, it should be pretty clear to you. What is the difference between risk sharing and risk financing? If the business is profitable on average, I can provide you money for the bad year, provided you pay me back in your good year. That is very simple reason. So I can provide you finance for risk without taking that risk myself. Of course, this arrangement would involve credit risk, counterparty risk. I pay you during the bad year, but you fail to pay me later on during a good year. So there is a way to reduce this risk, counterparty risk or credit risk or default risk. Financial reinsurance arrangements are typically provided by financial institution enjoying the most healthy credit rating called AAA+. But that does not make the credit risk zero. That minimizes it. That is the best bet that you can have. And regulators are happy with this. But if your financial reinsurance provider does not enjoy such a good credit risk, then the regulator will not be happy. And they have a very simple stick to deal with it. They would not allow this transaction to be considered for demonstrating solvency purposes. So whatever you pay to the provider, still you have to keep additional assets to prove your solvency. So obviously you will not go for this, because how will you manage that type of money? Invest here also and keep additional assets in some other form also. So that much financial money means not being capital efficient, actually rather being capital inefficient. So these deals will lose their important significance and attractiveness. But regulator being regulator is always concerned about your clients, the direct policyholder, the original policyholder's interest. So they will insist that you do something to minimize the credit risk. Okay. Now with this noted, let us move on to financial quota share. All of you understand quota share. That is my assumption at the start of this topic. You understand what is quota share. If there is a genuine quota share, you know how it operates, you know all the features. That is what I am assuming. I am not explaining that. Now, you must recall that in a genuine quota share arrangement, there is something called reinsurance commission. That the reinsurer pays to the ceding insurer, the cedant, for bringing business to it. Right? The financial quota share plays around this reinsurance commission. And a very simple graph will be sufficient to understand the idea behind financial quota share. Let us assume for a moment that year on year, there are no fluctuations, there are no variations in the agreement, in the premium. So commission remains same. So this is the reinsurance commission that you get every year under a genuine ordinary financial quota share treaty. Not financial quota share, genuine quota share treaty. This is how you are paid reinsurance commission in a financial quota share. Overcompensation. This is actually a lending to you. You are getting financed. Overcompensation. and paying back. According it will reach 0. This is the whole idea about financial quota share. This is how it is designed. So there is no element of risk transfer, or there may be some element of risk transfer. Retained proportion, ceded proportion, right? Set retained proportion very high, ceded proportion very low. So the element of risk transfer is very low. And at the end of the contract period, we will settle the balance. If reinsurer is in profit, return money. If reinsurer provider, affinity provider is in loss, payback. Or even limited risk transfer. Just superficially it is quota share. Technically it is provision of finance. And there is one more version of this. There is one more variety. Only in the first and the second year, or first, second and third year, or just in first year, overcompensation. And in all subsequent years, undercompensation. Simple. That is all about financial quota share. So the aim and intent is not to reduce risk or transfer risk or share risk with the direct writer. The aim and intent is to provide capital to the direct writer. And there is a very solid reason for such arrangements to emerge. There are n number of restrictions on insurers to seek finance. N number of restrictions. So these are easy shortcuts. Now we move to the last financial reinsurance arrangement to be discussed in this video, and that is industry loss warranties, or also called original loss warranties. They come in two varieties, binary or indemnity based. So they are basically inspired by options. So if you recall options, there is something called strike price. Unless the underlying assets price moves beyond that strike price, there is no payoff payable. This is called option. Again, in put option, again there is a strike price. Unless the underlying share price falls below that strike price level, there is no payoff payable, right? So they are guaranteed by such things also. Now the point is, there are two types of options. One is where the payoff depends upon the final price of the share or the underlying asset, or where the payoff is a fixed amount. Here the payoff is a fixed amount. Between the insurer and the financial reinsurance provider or the reinsurer, there is an agreement that a fixed amount, a fixed benefit will be paid, provided. The event that is covered in the contract, which is mostly a catastrophic event, usually a catastrophic event, earthquake, flood, typhoon, windstorm, and a time period, 1 year period. So, if the losses by the entire industry in that territory, USA, Canada, or Germany, or Europe, what may be the territory, if the total industry loss cross this point, if the total industry loss is say more than $20 billion, then $1 million we will pay to you. Oh, come on. This is plain betting. This is plain and simple betting. Yes, the binary industry loss warranty is plain and simple betting. A fixed payoff, and a trigger. It is immaterial whether the insurer has to pay some of those claims or not. If the industry-wide losses exceed that trigger point, let us call it M, you will get the fixed payoff. Okay. So there is another version for it, that is indemnity based. Very similar to binary one, but this is only first trigger number 1. For this payment to be made, there is a second trigger also. Trigger number 2. Only time 1. Your own loss due to that event, your own aggregate loss should, of course, M2 is much smaller than M1. If the entire industry has suffered losses of 20 billion, one single insurer out of that industry cannot suffer a loss exceeding 20 billion, right? So if this is $20 billion, this is say $2 billion or $1 billion, and the fixed benefit is say $10 million. So, if first of all the event does not take place at all, nothing you will pay, nothing you will get in return of the premium that you have paid, nothing. Your entire premium goes for a toss. The event occurs, but it does not cause losses exceeding $20 billion. The direct writer gets nothing at all, nothing at all. The event occurs, the industry experiences losses exceeding $20 billion, but this insurer itself does not experience a loss exceeding $1 million, the insurer gets nothing at all. The industry suffers a loss less than $20 million, but this particular insurer suffers a loss exceeding $1 million. Nothing. It receives nothing at all. Trigger 1 has not triggered. So trigger 2 does not matter. It is not important. So generally this figure is kept low compared to this. Very low. And maybe it is depending on the market share. So if this insurer has 10% of the market share in this industry, then this figure will be less than 10% of this figure. In my case, it is 5%. If this insurer has 5% market share in the industry, then it will keep it further low. Otherwise, there are no chances. There are very, very poor chances of payoff ever getting triggered. So, with the second trigger, we ensure that it is not pure betting. And the direct writer has some insurable interest in the risk event. That is all about financial insurance, but a very important question comes to mind. Very important question. How come this is not a proper reinsurance? How come it is not a proper reinsurance? What is lacking in this arrangement? What is lacking in this arrangement which does not make it eligible for being a proper reinsurance arrangement? That is a question I leave to you to be discussed in the doubt class. I want you to exercise your brains on this question, apply yourself, think of explanations that come to your mind, read, find, make it an open book question, right? Come back with your answers in the doubt class. We will discuss at length. Thank you for watching the video. That is all in this video. Run-off reinsurance will be covered in a separate video, solely for the purpose that I don't want to make this video very lengthy. If you really learned something from this video, please do not forget to like it, share it, and subscribe to my YouTube channel. You should also visit my other social media platforms like LinkedIn. Your support is very important. Thank you.